Hello, investors. This is Lukasz Labedzki, Senior Analyst at the Franklin Templeton Institute. Today, I would like to talk about Operation Epic Fury, but from a slightly different perspective, from the perspective of bond markets. Let me start by acknowledging that these events come at a terrible human cost, and we hope for a rapid de escalation of the conflict. Moving to our market highlights, what has been the historical reaction of the safe haven, namely 10-year US Treasury yields, to past military interventions that could serve as an imperfect reference for the current situation? Well, there is no clear pattern after crisis events. What the analysis shows is volatility along the way, but the median outcome was little changed with slightly upward pressure. That may be surprising to many, as the median doesn't suggest strong flows into safe havens. We are recording this on Thursday, and the first three trading days since the conflict escalated have indeed seen 10-year Treasury yields moving up, meaning bond prices have fallen. The current context is important. The chart refers to it, and the context is that 10-year Treasury yields entered the conflict at very low levels, disconnecting themselves from upside surprises on both the growth and inflation fronts. In other words, yields were prone to rebound. Does this mean treasuries don't offer hedging benefits? That would be an exaggeration. However, this dynamic has indeed been changing. Post global financial crisis, we were used to a negative correlation between bonds and stocks, with bonds hedging equity risk effectively. This changed significantly post COVID when the economy was dealing with a supply shock and the correlation between stocks and bonds turned decisively positive. Over the last couple of months, though, stock bond correlations have been improving, meaning they have been moving closer to or back into negative territory. We will be monitoring further developments. What is clear from the chart, however, is that you don't need to extend very far out the duration spectrum to obtain diversification benefits. How about credit markets? It's worth watching lower rated issuers, the high yield market, as it is more sensitive to the economic cycle and has a fairly good track record of sending reliable warning signals. What we've been seeing in this market is a rotation away from technology. However, the broad market does not seem especially worried today, as credit spreads for the high yield index remain low, which provides some degree of comfort. Can this change? Of course, it can. What matters is how long the current conflict will last and how severely it will ultimately affect the main transmission mechanism, oil prices. This should be monitored. Thanks very much for listening. Trade well, but most importantly, stay safe. Cheers.